Also got to talk about consensus on Wall Street. That seems to be that we're at recession crossroads, quote unquote. Though where we go from here, that appears to be anyone's guess. JP Morgan's Marko Kolanovic says that things might be getting better as the year progresses here, and it is very much a highlighter and pen type of day here on the desk. Particularly here, the JP Morgan view is that equity markets price in too much recession risk. However, they're also saying that equity markets, they estimate U.S. and the euro area equity markets are pricing in a 70% probability of a near-term recession. That's compared to 50% in high-grade credit, 30% in high yield, and then 10 to 20% in rate markets as well. They also call into question the April equity fund outflow, and particularly here when we saw heavy selling activity even early in the month of May as we continue to move through only the midway mark right now. And we're still consistently seeing that heavy selling pressure. That's exactly where some of the markets are already starting to pre-price in the risk of a recession ahead of the economic data actually revealing that as well.
Yeah, I have a little doom and gloom of myself there, Brad. I'm looking at a note from David Kostin over at Goldman Sachs, and he's noting that, quote, rotations within the U.S. equity market indicate that investors are pricing elevated odds of a downturn compared with the strength of recent economic data. So it is interesting to hear that type of commentary from a well-known name on Wall Street like Kostin, but really fires me up and gets me a little concerned here is that Kostin is really one of the first strategists to call out potential dividend cuts by companies. He's noting that dividend futures markets imply S&P 500 dividends will decline by nearly 5% in 2023. He notes that during the last 60 years, S&P 500 dividends have not declined outside of a recession. So something to keep in mind moving forward. And something I did see in a couple notes off of Cisco's earnings as well overnight, some concern about whether a Cisco will be forced to cut its dividend inside of a recession.
Yeah, so a lot of diverging opinions this morning. I'm looking at Deutsche Bank's Binky Chadha, his note where he cut his forecast for the S&P 500 to 4750. I mean, he's still obviously bullish from here. 5250 was his prior forecast. But I think more importantly here, he is looking at the scope for further sell-off before we get to a rally. He says right now, if you look at an average decline in the S&P 500 during a recession, it's 24%. So we're about 3/4 of the way there. But he's looking at the prospects for further sell-off based on, basically, we're seeing slowing growth. We are late cycle here. Secondly, he's looking at the drawdown in valuations for high-flying tech stocks. And third, he's talking about inflation and that the Fed is going to continue to raise guidance. Now, he says if we do go into a recession, that we are going to see a much more deep sell-off than is typical. So we could see something even 35 to 40% for the S&P 500. But he is a little bit more optimistic than that and thinks that we are going to have this drawdown and then there's going to be a bounce in the latter half of the year.